Hello and welcome back. It's funny to think that a simple silver coin, something you could literally hold in the palm of your hand, might just be the key to a much bigger story. A story about a potential crack in the armor of one of the world's biggest banks. Today, we're going to play financial detective. We're going to follow a trail of data that suggests something really unusual is going on behind the scenes in the precious metals market.
So let's just dive right in with this question. It seems almost unbelievable, doesn't it? But we're going to explore a theory that's been making the rounds with market analysts. And it all boils down to this. What happens when the demand for real, physical silver starts to put a huge strain on a financial system that mostly trades in paper promises?
It really is a classic David versus Goliath story when you think about it. On one side, you've got physical silver. It's a real, tangible asset that's been considered valuable for thousands of years. And on the other side, you've got JP Morgan, a true titan of global finance, dealing in incredibly complex financial instruments. The analysis we're looking at today suggests these two forces are on a surprising and maybe even dangerous collision course.
Now, our story really gets going in early January of this year. You had analysts watching the markets just like any other day when a single piece of data popped up that they immediately flagged as, well, really unusual. This was the first major clue that something was up.
The date to remember is January 7th, and the place is the COMEX, which is one of the main exchanges for trading metals like silver. So on that day, a delivery notice for silver futures contracts came out, and it contained something that made everyone who was paying close attention just stop what they were doing and lean in for a closer look.
And here it is. This is the detail that set off all the alarm bells. Out of 1,624 contracts that were demanding physical delivery of silver, a whopping 1,611 of them, they were all issued by one bank, JP Morgan. That's more than 99% of the entire day's physical demand, all coming from a single source.
So, what does that number of contracts actually mean in terms of real silver? Well, it translates to 8.12 million ounces of physical silver. That's a massive amount of metal that had to be physically found and delivered, all because of what happened on that one single day.
Okay, but here's where the story gets really strange. You would think, right, that after such a huge delivery of physical silver, that demand would kind of cool off for a bit. But what actually happened was the complete opposite, and that's what truly baffled the analysts.
So, to understand why this was so weird, you have to know that in the futures market, there are active months where a lot of trading happens, and then inactive months that are usually pretty sleepy. January is normally a very, very quiet month for silver. So to see a delivery of this size, well, it just completely broke the normal pattern of the market.
And this chart really shows you the paradox. After those 8 million ounces were delivered, you'd think the number of people demanding their silver would go down. But no. Instead, even more buyers showed up. The open interest, which is just a fancy way of saying new demand, it actually shot up in both January and February. It was as if more and more people were lining up and shouting, "Forget the paper, we want our silver, and we want it now."
To really get why this is such a big deal, we have to talk about the fundamental tension at the heart of the silver market today. And that is the huge difference between paper silver and the real physical stuff.
You see, most of the silver trading in the world doesn't involve actually moving heavy bars of metal from one vault to another. It happens with these things called futures contracts. And for the most part, they're just paper or digital promises. Most of the time, these contracts are just settled with cash. Nobody ever asked to see the actual silver. And here's the really mind-boggling part that the source we're looking at points out. It's estimated that the amount of paper silver being traded is somewhere between 300 to 350 times greater than the amount of actual physical silver that really exists and is available. Now, the system works just fine as long as everybody is happy just trading the paper. And that, of course, brings us to the billion-dollar question. What happens when a whole lot of people holding those paper promises all decide at the same time that they want the real, physical thing? Well, this is where we get into the theory of what's called a short squeeze.
The analyst in our source material really puts it perfectly. The moment a large number of investors demand physical delivery, that's when the paper-based system faces its ultimate test. It's the absolute nightmare scenario for any big bank that is net short, which just means they've basically bet that the price of silver is going to go down.
So let's just walk through how this dangerous feedback loop works. It all starts with that surge in demand for the physical metal. That forces the short sellers to scrabble out into the open market and buy that same metal to make good on their promise. All of this new buying pressure, of course, sends the price of silver spiking upwards, which makes the financial losses for the short sellers even worse. It's a vicious cycle that can really spin out of control.
We're about to put the final and maybe most important piece of this puzzle into place. But first, just a quick pause. If you're finding this explainer interesting and valuable, please take a moment to like, share, and subscribe so you won't miss any exciting updates. It really helps us keep bringing you this kind of analysis.
All right, let's bring this all together and look at the bigger picture. Is what we saw back in January just a weird, one-time thing? Or is it a sign of a much deeper problem that's brewing in the market?
Well, this growing pressure on the physical supply could be why we've seen such wild swings in the silver price lately. I mean, jumps of 10% in a single day, that used to be incredibly rare. It suggests there might be a fundamental shift happening, where investors are starting to lose a little faith in paper promises and are instead demanding real, tangible assets that they can actually hold. Now, the source material we looked at doesn't claim to have the final answer, but it definitely leaves us with this very provocative thought. Are the events we saw back in January just a small tremor, or are they a warning sign of a much bigger earthquake to come? The evidence seems to suggest that the foundation of the paper-silver market might be a lot more fragile than many of us believe. And it makes you wonder, if one pillar starts to show cracks, how strong is the rest of the building? What do you think?